Thank you, Mr. Chairman. Mr. Bovenzi, nice to see you again.
Good to see you, too.
Thank you. I had a few questions for you about the banking system in general. The American Enterprise Institute says that 2/3 to 3/4 of all the bad assets in this country are actually held by only 4 banks: Citigroup, Bank of America, J.P. Morgan Chase, and Wells Fargo. Is that correct?
I don't have an answer for you offhand. Certainly, you take those 4 banks, and they're going to comprise a large portion of the banking assets in the country and in general. So, just even proportionally, they'd have a large portion. But offhand, I don't know the answer to that question.
Well, when you pass laws and allocate money to help banks in trouble, are we basically just helping these 4 banks?
Any program that's put in place, certainly our view is it's to help all banks and should be to help all banks. And granted, as some of the programs are being rolled out, it's getting to the larger banks before it's getting down to the smaller banks. But I think it's an important principle that all banks are eligible for capital investments or programs that go forward with the government.
Well, I'm more interested in the practice than in the principle. Why is it that it's taking more time for money to get to the small banks than it is for money to get to these 4 giant national banks?
Well, with the capital purchase program, as it was originally rolled out, it was the first group eligible were public corporations, and by their nature, that's more of the larger institutions. It was then rolled out to private C corporations. Only recently have we been able to get the term sheets and standards in place for Subchapter S corporations so they can start receiving capital injections, and we still don't have the appropriate term sheets for how to invest in mutual organizations. So the rollout has been slower for the smaller ones, and that's certainly been a cause for concern from the FDIC's point of view.
Well, by giving tens of billions or even hundreds of billions of dollars in aid to these 4 banks, aren't we basically rewarding them for mistakes that they made?
I think the intent of all of these programs is to try to stimulate the economy, and an important part of that is stabilizing the banking system as a whole. So we do need to take steps. We talked about key components of doing that is providing capital and liquidity. The larger banks are going to be an important part of re-stimulating the economy, and by necessity are going to be an important part of any programs that come about. But at the same time, smaller banks lend in local communities, and that has an important effect too. And certainly with the program that the FDIC has, the Temporary Liquidity Guarantee Program, we have 7,000 banks that are taking part in the non-interest-bearing transaction account guarantee, and about the same number of banks and thrifts and holding companies taking part in the unsecured senior debt guarantee. So it is a program that is very broadly based across the banking system.
We sometimes hear the phrase moral hazard. Isn't it basically violating the moral hazard principle to offer so much aid to these 4 banks because of the mistakes that they made in accumulating $1 trillion or more in bad assets, and not helping the smaller banks who could provide stimulus and help local communities around America?
Well, certainly it's a general principle. We want to avoid moral hazard. We want market discipline in the economy. I think as we've gone through this financial crisis, there have been a great many shareholders and senior debt holders who've lost a great deal of money, and so I think they'd certainly view the market as having provided some discipline. I think when you get into a situation as severe as the one we're in, then we need to look at systemically what needs to be done, at least for that period of time, to take care of the bigger issue, which is the financial stability of the country.
What discipline has there been for the managers of Citibank and Bank of America and J.P. Morgan and Wells Fargo? Hasn't it basically been business as usual, even though they've lost $1 trillion?
Gentleman's time has expired. Mr. Bovenzi?
I just respond that there are a number of different situations, but there's certainly, I think, many people in charge of organizations who've lost their jobs. But I agree with your broader point that if the government's putting in money, we need to be looking at things like executive compensation, appropriate management, and how the money's being
But the time has expired. I do want to point out, in fairness to Mr. Bovenzi, that it's the Treasury Department that ran this. The FDIC made none of these decisions. As a matter of fact, by the end,